Yes, so the next speaker is Rajeev Agarwal, CFA. He's a fund manager and managing partner at DoorDarshi India Fund. DoorDarshi India Fund is based out of the US and enables investors to benefit from opportunities in Indian markets. Rajiv has been investing in the US and Indian equity markets for over 15 years now. He follows value investing principles and finds that the Indian equity market provides wonderful opportunities for his style of investing. Prior to starting DoorDarshi, Rajiv was a technology executive focusing on financial industry and has worked in IHS Market, Goldman Sachs, Bank of America, JP Morgan, Dresdner Bank, and he's also a BTech from IIT Bombay and MBA from IIM Calcutta. So let's welcome Rajeev Agarwal for his session. Thank you so much, Rajiv ji, for taking time out for educating our fellow investors. And over to you, please.
Thanks a lot, Vivek. I hope you are able to hear me all right.
Yes, please. We are able to hear. Go for it.
Wonderful. My voice is a little not working as well, but I will try to do my best here. You are able to see my screen?
Yes, we can see your screen.
Fantastic. Okay. So as Vivek said, I am the fund manager and managing partner at DoorDarshi India Fund, and it's great to be speaking at this Investing Accelerator Summit 2022. In this industry, the first thing we have to do is to talk about the disclaimers. So the first thing is the content of this presentation is only for the information of the participants and not to be construed as investment advice. Please consult your financial advisor before acting on it. And also, we are a foreign portfolio investor. So DoorDarshi India Fund is registered as a FPI into India. And so that is our SEBI registration status. And the security that we are going to talk today is something that our fund owns. And clearly that therefore we are pretty biased about what we are talking about. We own it and therefore we like it. And obviously we feel it is a good opportunity, right? But as I mentioned, everybody should do their own diligence and talk to the financial advisor before participating in it. A little bit of the agenda. So we'll talk a little bit about the background. And then the idea I'm presenting today is Ujjivan Small Finance Bank. A little bit of the background, I think we talked about it. So I did my corporate journey for the first 2 decades of my life from 2016 and before. And then from 2017 to present, I have been on an entrepreneurial journey, and I must say it is wonderful. So apart from what he talked, which I will skip, I'm also a top-ranked analyst on SumZero, and I'm very happy to report that in November of 2022, I have been ranked #1 in East and South Asia, #1 in financials, and #1 in special situations, and that is across 15,000 plus analysts on the SumZero platform. So that's all good. A little bit about the fund, as I think Vivek also mentioned, we are a US-based fund that focuses on investing in Indian equities, and our goal is to seek superior returns by investing in compelling opportunities. So the fund is a FPI Category 2 fund with SEBI. We take accredited investors who come into the fund, and then DoorDarshi Advisors is the general partner. We are a long-term focused fund. So with that quick introduction about ourselves, let's dive into the idea that I'm presenting today, which is Ujjivan Small Finance Bank. So as of the Friday, the stock is currently at 27.4 rupees a share, which is approximately a market cap of 5,300 crores, which is approximately a price to book of 1.9x and price to earnings in our mind. And this is our assessment of it. Clearly, this is not what you will see if you look at the trailing 12 months. But in our mind, we think it is available at something like 5 times what financial year 23 earnings will be. And we'll talk about it. In terms of ownership, it is 73.7% owned by Ujjivan Financial Services Limited, which is the parent or the promoter company of Ujjivan Small Finance Bank. And from a management perspective, Itira Davis is the managing director and CEO of the bank. So a quick background about the bank. The bank was started in 2017. And when it was started, Ujjivan Financial Services Limited transferred all its operations to Ujjivan Small Finance Bank, and Ujjivan Financial became a holding company. Over the last few years, Ujjivan Bank has built out the infrastructure for banking. This involves rolling out a branch network to take deposits and roll out new financial products while building out the infrastructure has been costly. It has enabled the bank to be much more resilient. And we think that at this point, Ujjivan Bank is on the cusp of major growth opportunity, and we'll talk about that. So if you look at the most recent quarter that they have announced, the business has been on a fast track. If you look at the disbursements in the last 4 quarters, it has consistently been above 4,000 crores. And what that is translating into is a pretty good growth in advances. So 16,000 crores, which was in December 2021, has become 20,900 crores. The asset quality is improving quite significantly. You can see the portfolio at risk, which used to be around 15% at end of December, is around 6.1%. There's a very good reduction in gross and net NPA. So net NPA is almost zero, while gross NPA is 4.4%. And in terms of profitability, you can see that the net interest income has continuously been improving. It's around 663 crores for the most recent quarter. And pre-provision operating profit is 385 crores, which is translating into very good profit after tax. Now, if you look at how the loan growth has been achieved across what particular segments of the loan book, what you will notice is that across all loan categories, they are experiencing good growth. So on the right-hand side, you can see micro group loans, and this is basically the joint lending group, JLG loans that is typically given out by microfinance. That has grown at a 52% year on year, and pretty much across the board, they have seen very good growth. And overall, the book has grown by 44% year on year and 8% quarter on quarter, right? So you can see the division across different segments. And we think that this growth is coming because of good monsoon, but also because there's a good demand from the rural economy as the businesses come back online across most of the rural areas. Now, the other important thing is they're disbursing a lot of loans, which is good, but are they getting good yields? And this is where you will see on the right-hand side that on average, the yield of the portfolio is around 18.2% in the most recent quarter. And so the yield has continuously been improving. It was 16% in Q2, became 18% overall, and now it is 18.2. So that's great to see that the yield is improving, and clearly there is a good demand for loan. And not only have they been able to improve the yield, but they're also keeping a tight control on the ticket size. So you will notice that the group loans, which is again at the bottom, that the group loans ticket size has come down somewhat, and that is because they're now able, or they're increasing new customers into the group loans. In terms of individual loan, also they have reduced the ticket size in Q2 on an average, which again shows that they are making it more granular. While on the medium and or micro and small enterprise, they basically have increased it because these are typically loan against portfolio, and so they are much more secure. And affordable housing, again, they are in the same sort of area. So overall, I think the book is not only growing, but growing with a good yield. And the ticket size is something which gives us comfort that they are not just trying to disburse loans, but also doing it in the right manner. Now, all of this growth is supported by strong deposit growth. And so you will notice that if you look at on the right-hand side top chart, you will notice that the institutional term deposit, which was 6,400 crores in September of 21, is 7,300. So it has not grown as much, but the retail term deposits has grown a lot, and so has CASA, right? And CASA is current account and savings account balances, right? So you can see that most of the loan that they are extending is being provided by increase in the deposits. Now, the bank has a good ALM position. So you will see that the credit to deposit ratio is around 103%, which seems high. But when you account for the securitization of the book, then you will see that it is around 90%. And that's good. It's pretty comfortable, and they will be able to continuously grow the deposits. The retail percent share of the deposits has gone up to 61%, as I was mentioning, that they have been growing that, and that's very good. And they continue to have very good rating of A1 plus on the certificate of deposits. Not only are they growing the retail deposits, but if you look at the cost of funds, which is on the left-hand bottom side, you will notice that the cost of funds is 6.1%, which in current environment is pretty compelling. And they are able to do that by both deposits around 6.2% and then 5.2% at the CASA level. So overall, good growth. Growth is quite distributed. Growth has good yields, and it is all supported by very good deposit growth. Now let's look at how they are collecting the EMIs from the customers. So if you look at the collection efficiency, even the collection efficiency is improved. So on the top chart, you basically have the orange color is where you have all collections. And then the green chart shows the collection for the month due. And you will notice that in September 22, it has been 100%. And for Q2, it was pretty much between 99 and 100%. So because of this very good collection efficiency, you will see that the asset quality is becoming even better, and the stress is coming down in the next slide. But also, these collections are being done in a cashless manner. And so this not only helps them track everything much faster, but it is also improving the operational efficiency of the business. Now, this collection efficiency has been possible because bank did hire a lot of additional staff, which was really contractors, which is reflected as total off-roll staff. And you can see that the off-roll staff went up quite a bit in between, and now it has been coming down. And what that shows to us that ultimately the operating cost will come down, and that will take care of the fact that the ratios will continue to improve. Now, I mentioned about collection efficiency. Let's look at the asset quality, right? So I mentioned the PAR has fallen. PAR is portfolio at risk. And what it is doing is it is looking at all the portfolio where there is any delinquency, right? So you are looking at SMA 0, which is 0 to 30, 31 to 60, and then 2, which is 61 to 90, and then above 90 is NP, right? So when you're looking at it for September 22, the recent quarter, it is 6.1%. And if you account for the restructured book as well, so PAR plus restructured, which is the total stress, if you want to look at it, it is 6.8%. And obviously, the trends are really looking good. So what used to be a 25% stress has come down to 6.8%. And as we saw in the previous slide, that all of this is possible because of very good collection efficiency that the bank is seeing. And also, they're seeing good demand. And so when you see good demand, then the customers want to pay off the previous loan so that they can take on the new loan. Clearly, all of this is reflected in low gross NPAs. And because of very high provisions, they have a net NPA of 0. Now, if you look at the provisions, I mean, obviously, they have provided for all the gross NPAs, but they have, in addition, a 60 crore of excess floating provisions to take care of any excess or any contingencies that they may have in the future. Now, all of this is really translating into some phenomenal earnings and also good returns on capital. So if you look at it on the right-hand side, the profit after tax is 294 crores in the most recent quarter. And if you look at the bottom, the return on assets and return on equities for the most recent quarter is a phenomenal 4.6% and a 34.5%. Now, also, if you look at the capital adequacy ratio, it is 26.7%. And what that tells you is that the bank does not really need any new capital. They did have a capital infusion, which happened in Q2 because they wanted to bring down the shareholding of the parent below 75%, and we'll talk about that. But effectively, it seems like the bank is in a very good position to grow its loan book, does not have to dilute anything, and the asset stress that they have seen is continuing to come down. So these are our expectations of what we think the bank will do. So bank management has talked about having 30% loan growth in financial year 23. And if we look at what they have done already for the first half of financial year 23, they've already grown 15% from the end of financial year 22. So I think they are doing pretty well in terms of the loan growth. Now, as the loan book grows, operating leverage will drive earnings growth. And so our expectation is that that should grow at a faster pace. And I also mentioned about the collection cost coming down. We expect that the credit cost in financial year 23 will continue to be very muted. And that is primarily being driven by low net non-performing assets and good recoveries, and the fact that they have floating provisions. As if you look at the H1, the total earnings have been 497 crores, and we think that overall earnings in financial year 23 of around 1,000 to 1,100 crores is quite doable. Now, this is a conservative estimate in our mind, and we'll see what the bank does. But the earnings in second half will be slightly lower because of two reasons. One is other income will be lower because in H1 they had higher priority sector lending certificate income, and stronger recoveries was there because the written off assets were much bigger. However, bank management in the call indicated that they are pretty comfortable of not only having the run rate, but possibly even improving it in the H2. So as I mentioned, at 27.4 rupees a share, it's around 5,300 crores of market cap, and that is around 5 times the financial year 23 earnings in our mind. And so we think that even if the shares were to double from here, we think there is it will only be trading at 10 times earnings, and that is still quite cheap the way we think of the bank. And it actually gets better. And it gets better because the bank is 73.7% owned by its promoter, Ujjivan Financial, right? We talked about that. Now, RBI in 2021 allowed the holding companies to reverse merge with the corresponding banks after 3 years of operation. And both the boards of the bank as well as the financial company have agreed on a reverse merger where the holders of the financial services companies will get 11.6 shares of the bank. So if you do that calculation, you will realize that you can buy the bank shares today at an 8% discount to the current price that is available for the bank shares. And so you can actually even create a security which is cheaper than what the bank security is. So summarizing my thesis, we think that the bank is trading at 5 times to our expected earnings. For a niche focused bank, we think at 10 times is still very cheap. We think that the reverse merger with Ujjivan Financial means that the bank shares can be bought at a lower price by buying the Ujjivan Financial shares. Now, management team has been in the microfinance space for a long time, and they understand the business quite well. So we think we are in pretty safe hands. Management is committed to completing the reverse merger, so we don't think there is any issue there. And we think there are actually additional triggers in the future. And some of those triggers are that the small finance bank is now eligible to apply to become a universal bank. And so we think that once the reverse merger is done, that's what they will do. And that will give them much more flexibility to grow the earnings. In addition, we think that given the credit or given the capital that they have, they will continue to be able to grow in financial year 24, which will further drive earnings. And what are some of the risks? We think that macro environment is a risk everywhere. And if it has any impact on Indian economy, it may compress the valuations. Now, majority of the bank business is uncollateralized loan. And if economy suffers, asset quality will suffer. We think that attractiveness of MFI segment may lead to much higher competition in the future. And there may be some delay in the timelines if one were to buy the Ujjivan Financial. And here are my contact details. Happy to take any questions either now or if we are running out of time, have to take them through the mechanisms that I've listed here. Vivek, back to you.
Thank you so much, Rajeev ji, for sharing this insight in a very, very crisp and to the point way. Amazing stuff. And hope all of you also enjoyed the entire thesis, how the thought process, goes on. And as we said, it is just for you to, put your mind in the shoes of all these smart fund managers and investors so that you can also, start practicing how to think about companies and your investment thesis. So amazing. I think one question we can take quickly is from Anirudh. He is asking, considering an upcoming recession or slowdown, how Ujjivan will perform considering the income profile of the customers?
Yes. So I think I am not so sure if we are seeing recession or likely to see recession in India. I think there is definitely recession possible in Europe, and there is some possibility in the US. But I think that way India is really well positioned. And if anything, we are seeing very high credit growth in India. And we are seeing that because the economy is growing and suddenly the businesses are growing. So we are not anticipating that there will be recession in India. Were there to be a recession in India, then as I mentioned earlier, I think there is definitely going to be some risk to what I've laid out.
Great.